Let's get straight over to Rick Santelli. He's got that data for us this morning. Hey, Rick.
Yes, Becky. GDP, second time around the block on the first quarter numbers, expected to be up 1.3, and it is up exactly 1.3. So we subtract 0.3 from our first look at 1.6, still comps to the second quarter of 22 when we were down 0.6 in terms of last time we were at these levels of GDP activity. Now, if we switch gears to consumption, 2%. We're expecting 2.2. It was 2.5. That's a rather large revision. 2% is the lightest since the second quarter of 23 when it was up 0.8. And consumption's a big deal. The consumer's a big deal. This is going to go a long way to potentially assuage fears that the next move may be a tightening. On the price index, 3%. 3%. We're expecting 3.1, and the rearview mirror was 3.1. Still comps to 1.6. 1.6 was the lightest. That was the last quarter of last year. And keep in mind, the third quarter of last year was 3.3. So we could see that, it is a drop, but it's still well above the 2% target. Now, core PCE, personal consumption expenditure price index, quarter over quarter, 0.1 drop from both expectations and the rear view mirror. From 3.7, new read 3.6. 3.6 still comps to the last quarter of last year in terms of smaller inflationary pressures when it was just 2%. Now, let's go to initial jobless claims. 219,000. That's up 3,000 from a slightly revised 216,000. It continues to be rather tame, and we see continuing claims remain under 1.8 million at 1,791,000. We haven't been above 1.8 since the last week in March. Now, let's look at the trade balance, which is a deficit, expecting minus 92. It's bigger, minus 99.4 billion. That's the largest trade deficit going back to, I'm going to have to cipher on this one, going back to, that's taking us back all the way to May of 22. May of 22. Let's call it 2 years. And if we look at wholesale inventories, they were up 0.2, close to expectations, reversing a negative month-over-month change of minus 0.4 last month. And finally, retail inventories, double expectations, up 0.7. That is the biggest jump in those since it was up 0.8% in the last month of 2023. How did all that affect the markets? Well, we're a couple of basis points lower in a 10 at 457 after having a high yield close going back to April 30th. We look at a 495-ish, which is down a couple of basis points in a 2-year, and it looks as though the auction pressure is off. This is a new dynamic. We had 2s, 5s, 7s, and when we're focused on those, it certainly seems as though long rates in particular, but all rates were more buoyant to the upside. After the auction ended yesterday with a 7-year, which wasn't spectacular by any means, we saw the market rally a little bit, very normal. So if it's not right in front of investors, maybe they're not putting the link with the fiscal situation that we are in. Joe, a lot of numbers. Back to you.
All right.
Rick, I was going to say, AI's got nothing on you. I'd like to see any of those chatbots try and do what you just did with that. Because I was barely keeping up as I was writing it down. Well done.
Plus, I really like it. I hope viewers like it as much as me. This is the formula. These are the ingredients that move the economy.
They are. And we're watching them very closely. Rick, thank you.